Welcome to Sheet Tech Trading. In this session, we are going to share about the candlestick patterns. Already we have learned about the bullish candle and the bearish candle. Now we are going to learn about the top 5 powerful patterns. A quick recap. So a bullish candle and the bearish candle. Patterns are separated into bullish or bearish. Bullish pattern indicates that the price is likely to rise, while the bearish pattern indicates the price is likely to fall. No pattern works all the time, as candlestick pattern represents a tendency in the movement, price movement, not guarantees. A dark or red color candle indicates the close was below the open, while the white or green color candle highlight the price closing higher than it's opened. So this is how it is separated by the candle is separated as a bullish and a bearish. So the first example is a bearish candle. For the bearish candle, the open close will be below the open, that is the price opens higher and closes near to the low. So the price comes down, and this the shaded part is called the body of the candle, and the short line, it is a short shadow, this is called wick, and this is lower wick and this is the upper wick. And for a bullish candle, the criteria is the open within in the lower end and close in the higher end, that is the price opens lower and moves upward and closes above the open, and it is a bullish candle. So this gives example of the bullish candle and the bearish candles. So you have to keep in mind three important things, that is open, close and the wick size. This is the wick size decides the trend of the market, or it decides the who is in control, whether the buyer is in control or the seller is in control. Small wick represents nothing going to impact, but when the wick is long, it represents, it gives us some meaning. So it is considered in while deciding the trend of the market, or while deciding who is in control of the market. There are various candle patterns used to determine price directions and momentum. Two kinds of expected pattern outcomes are reversal. Candle reversal patterns predict a change in the price direction, and continuation, while continuation pattern predicts an extension in the current price direction. Example of the bearish engulfing pattern. The first candle is a bullish candle. For a bullish candle, the open near the low and price closes above the open, and it is called the bullish candle. The second candle is a bearish candle. The criteria of the second candle should be the second candle opens above the previous close of the previous candle's close. So what is the first criteria? The opening of this second candle should be above the close of the first candle. So it should open above the close of the first candle, and the second candle body cover whole body of the first candle. The body of the candle, the first candle's body should be fully covered by the second candle. This is the second criteria. And the third criteria is the close of the second candle should be below the opening of the first candle. So if you check here, the close is below the open of the first candle. So this is the criteria for a bearish engulfing pattern. So as a quick recap, the first one is the first candle should be a bullish candle, and the second candle should be a bearish candle. The second candle, the open should be above the previous candle's close, and the body of the second candle should fully cover the whole body of the first candle. And the third criteria is it should close below the open of the previous candle. And the next candle gives you it is called the confirmation candle. So after the next candle opens, you can sell below the close of the confirmation candle, and you can place the stop loss above the high of this bearish candle. So if you are placing above this high, you can add or say for example 0.5% of the price and 0.25% of the price, that is higher plus 0.25, you can keep your stop loss, and you can have a sell position. So in the live market, let us watch the patterns. The first one is the engulfing pattern. So in this, the trend is uptrend, and here a bullish candle arises. The next candle is a bearish candle. The criteria is the close, the open should be higher than the close, and the market moved up and the price got downward direction, and the close is below the open of the first candle, so it is an example of the engulfing pattern. So what happens, you get the confirmation from the second candle to get a sell. So if we move for more confirmations, you can add on moving average, RSI, commodity channel index. So all these trends and oscillators you can use for taking a call to sell, to get a confirmation whether the market is in a sell trend. So to get that confirmation, additional confirmations, you can use all these tools. So this is an example of an engulfing pattern. And while placing a stop loss, you need to place above this high plus 10 or 15 paise or 25 paise. Additional, you can keep a plus or minus 25 paise and keep a stop loss, and you can have a sell, and you need to book a stop profit when it is nearing to your support line. You need to draw a support line and check what will be the targets. So hope this you have given on the live example about the engulfing pattern. So let us see why are engulfing candles important for traders. Engulfing candle assists traders to spot reversal indicating a strengthening trend and assist traders with an exit signal. So two options to know the strength of the market and where to exit. This engulfing patterns helps the traders. Reversal. Spotting reversal are self-explanatory. It allows the traders to enter a trade at the best possible level and ride the trend to completion. Trend continuation. Traders can look to the engulfing pattern to support the continuation of the existing trend. For example, spotting a bullish engulfing pattern during an uptrend provides more conviction that the trend will continue. Exit strategy. The pattern can also be used as a signal to exit an existing trade if the trader hold a position in the existing trend which is coming to an end. So in the chart we have shown the engulfing pattern. So the trend is upward and there occurs an engulfing pattern, a bullish candle and the bearish candle and a confirmation candle, so that if you are holding a long positions, you can exit your position and you can book your profit. The limitations of the engulfing candle can arise when the pattern turns out to be more of the retracement and than a definite change in the direction. But traders can look for a subsequent price action to reduce the likelihood of these undesirable outcomes. Using an engulfing candle reversal strategy, traders can look to trade the bearish engulfing pattern by waiting for the confirmation of the move by observing subsequent price action, or to wait for a pullback before initiating a trade. So as we discussed in the chart, we have taken the bullish candle and the bearish candle and the confirmation candle. The bullish and the bearish candle together is referred to an engulfing pattern. So we are waiting for the confirmations. After the confirmation candle occurs, you can use tools like indicators and oscillators and trends. You can use all these for an additional confirmations. By getting the confirmations, and you can wait for the pullback to execute your trade. Look for a successful close below the low of the bearish engulfing candle. Alternatively, traders can look for a momentary retracement before entering a short trade. So before entering a short trade, you have to check all these things. You need to check the confirmation candle, and you need to check the indicators, whether all the indicators is giving a sell signal. Everything if you are checking, then you can go into a trade. Stop loss. Stop loss can be placed above the swing high where the bearish engulfing pattern occurs. So as I told you in the chart, so where you need to put your stop loss is above the high of the bearish candle and taking a profit. The target can be set at a previous level of support while ensuring a positive risk to reward ratio. So you need to draw a support line to check your profit, and when the price reaches near to your support line, you can book a profit, and or you can take a profit level. So that point you can keep as your profit point. The next one is the bullish engulfing pattern. An engulfing pattern on the bullish side of the market takes place when the buyer outpaces sellers. This is reflected in the chart by a long green real body engulfing a small red real body. With bulls having established some control, the price could head higher. The bullish engulfing candle provides the strongest signal when appearing at the bottom of the downtrend and indicate a surge in the buying pressure. The bull engulfing pattern often triggers a reversal of an existing trend as more buyers enter into the market and drive the price up further. The pattern involves two candles with the second candle completely engulfing the body of the previous red candle. Interpretations. Price action must show a clear downtrend when the bullish pattern appears. The large bullish candle shows that the buyers are pulling into the market aggressively, and this provides the initial base for further upward movement. Traders will then look for a confirmation that the trend is indeed turning around by making use of the indicators, key levels of support and resistance, and subsequent price action after the engulfing pattern. So as we discussed it earlier in the chart, we have used the same indications. So the same thing we are repeating in the form of a sentence. So it will make you to understand in a better way. Now let us check what is a bullish engulfing pattern and the key criteria. The first criteria is the market must be in clearly defined downtrend. So the market should trend downwards. So the market should be in the downtrend, and the first candle should be a bearish candle. So the second candle should be a bullish candle. For a bearish candle, the open prices close below the open, and for a bullish candle, the prices closes above the open. So here it is open. So this is an example of a bullish engulfing pattern. So the first candle is a bearish candle and the second candle is a bullish candle. The bullish candle closes above the previous candle's open, and the bullish candle opens lower than the close of the previous candle. So it should open lower from the previous candle, and it should close above the open of the previous candle. So this is the criteria for the bullish engulfing pattern, and the body of the bearish engulfing pattern should fully engulf into the bullish candles. So this is how the candle looks like, and this gives the reversal trend in the market. So we have today learned about the engulfing pattern. You need to practice in the live sessions. So take a reverse test and find out which are the engulfing pattern where it has taken a reversal, and you need to, because backtest is very much important for training in the technicals. So take a backtest to identify the engulfing pattern and a bearish engulfing pattern, bullish engulfing pattern, bullish candles, bearish candles, and again we'll upload the other patterns also, so it will help you to understand in a better way. Hope this session is useful. Don't forget to subscribe, like and share with your friends. We'll be back in next video. Till then, have a nice day.